Hello, my friends. This is Paul Drockton, America's #1 financial expert, and we're going to talk about term insurance. And what is term insurance, and why is it so cheap? Well, to understand term life insurance, you first need to understand mortality risk. What does that mean? It means every year that you get older, the risk of death increases. So clearly, there's a lower risk of death for a man in his 20s than there is for a man in his 50s. The same holds true for a woman. You will note that the risk is lower for men aged 50 and younger. And you will also notice that that increases as we get older. So the risk of death at age 85 is extremely high versus the risk of death at age 25. So 1 in 1,000 will die at age 25, whereas 1 in 9, 1 in 8 will die at age 84. So if you understand the risk, then you begin to understand the cost. Term insurance is pure life insurance and no cash values. What you're basically doing is you're giving the insurance company your money in exchange for some kind of guarantee that you will get back a much larger amount of money in the event of death. It's designed to provide a large amount of insurance for younger individuals for the lowest possible cost. And it's low mortality that makes that lower cost possible. Now, from a financial expert perspective, the primary purpose should be replacing the income of a primary breadwinner in the event of death. So if you live in a household where you're a primary breadwinner, then you should be looking at term insurance as income replacement. And if you live in a two-income household, then you should be looking at two term insurance policies, which, by the way, I get into on my website, moneyteachers.org. Now, it's called term insurance because it only covers a specific term of time in your life. Now, initially, all that was available was annual renewable term insurance, which renews annually without a physical, but the premium increases annually as well. And eventually, as you get older, it becomes too expensive to maintain. So, annual renewable term, cheap when you're young, very expensive as you get older. Now, if you're willing to pay an average premium, in other words, instead of going for the lowest premium possible, which is available through an annual renewable term policy, then you should look at a fixed premium term life policy. Long story short is you're going to get the same payment for a fixed period of time with the same amount of life insurance. For example, a 10-year term policy gives you fixed premium and coverage for 10 years, and then they go away. So the policy literally will lapse. You can't renew it. It's gone unless it states it's renewable, in which case you're going to start at the age you are at. A 20-year term policy is also available through most insurance companies, and so is a 30-year term policy. Now, when you start going beyond that, like a 40-year term, you're technically getting into a whole life policy with no cash benefits. So long story short, remember the purpose of the policy. Go to my website, moneyteachers.org. Here's the thing, my friends. I want you to understand the basics because I want you to understand how critical it is for you with your limited resources to pick the right policy with the right company for the right premium for you. And you can do that with my hand-picked life insurance specialist for free. He'll consult with you for free. Or if you have more complicated needs, you can consult with me. Or you can pay $4.99 per month and let me teach you everything you need to know about life insurance, investments, money management, real estate mortgages, etc. This is the United States' foremost financial expert, Paul Drockton. And remember, any way you choose, you win. Just go to moneyteachers.org. That's www.moneyteachers.org. This is Paul Drockton. God bless.